actually quite common if you actually started to buy your first house. So most of the time, I would say your bankers will tell you, no, you will have to buy an insurance with the bank when you apply for their loans, especially for the housing loans and for commercial buildings loan. So normally what they will tell you to get is, of course, your fire insurance to cover the property, as well as for the borrower they will need to get MRTA. Right. So let's look into what is MRTA or MLTA. Alright, so basically I took this slide from some of the websites available. Alright, so basically I would say the most simple way to explain MRTA is a mortgage life insurance, where you cover your life as a borrower to repay the bank for the loan that you took from them to actually buy your property. So in this case, it's subdivided into two. Both are actually life insurance. Basically is insured by a life insurance company, but MRTA is basically financed by the bank. You normally will be able to finance up to 5% additionally on top of your 90% loan. So in that case, you actually pay one lump sum as a premium payment towards the insurance company, but you are repaying back in the form of an installment every month, of course with additional interest since you actually took the loan with the bank to actually buy this insurance policy actually. So what is MRTA is basically quite simple. As you first took up a loan, let's say $500,000 ringgit, 500k on the first year itself. So as your loan progresses, if let's say your loan tenure is up to 30 years, the coverage of the MRTA is, the full name is actually Mortgage Reducing Term Assurance, meaning to say every year as the loan progresses, the value of the insurance coverage reduces over time. So assuming something happens at the 20th year, as you are repaying the loan itself, the payout maybe will have dropped until 200,000 from 500,000. So in this case, if assuming there is no interest rate increase to a certain point, then the MRTA should be able to repay your loan installment. However, if let's say there's a hike in interest rate, then there may be an additional amount that you will need to settle off on top of what is payable already by the insurance company. Alright. So another thing, of course, we need to take note is that MRTA is non-transferable, meaning to say that if let's say today you are taking up this loan with the bank and you bought this MRTA, is attached to this particular loan agreement. So assuming let's say in the future you plan to buy another property in 5 to 10 years time, or you choose to refinance the property, you will need to rebuy another MRTA. So as we know that life insurance itself will cost much more expensive as you grow older due to your mortality rate and also morbidity. Right? So in this case, as you grow older, you will need to also pay more for your purchase of the MRTA. Alright? So in terms of cash value wise, if assuming you are taking the loan all the way to 30 years and you plan to keep the property, you don't want to refinance whatsoever, so there's no value to the MRTA. Basically it's just like your car insurance. You pay the premium for that year. If you have not claimed anything, it will just burn. So in this case, of course, it will burn off in 30 years time. But of course, if you choose to surrender it in the earlier years, let's say on the 5th year, 10th year, 15 years, there will be some remaining balance that you will be getting back. Alright? Okay, so for MLTA is basically, again, is also a life insurance. You basically buy it directly with insurance agents or financial advisors. So basically, MLTA, there's a few types. There's what we call as a level term assurance. Alright, so what it does is basically it covers the same amount throughout the tenure of the loan. Alright, or in this case your lifetime lah. So if we take the same example, $500,000 ringgit, and the coverage is up to 30 years. So in any event that if let's say death occurs, the payment will be paid is at 500,000, but assuming the same scenario, your loan balance is 200,000 on the 20th year. So in this case, you will have a surplus of 300,000 ringgit that is payable to the nominee that you have actually nominated in the policy. So in this case, your family members or your next of kin would have surplus money to do all the necessary to pay professional fees, to pay for any fees to be incurred while transferring the estate over. All right. So what it means by transferable is that MLTA, like your life insurance policy, it covers based on your name instead of being attached to the loan itself, unlike the bank's MRTA. So in this case, assuming in the future you plan to buy another new property, all right, or you choose to refinance at a higher amount. Let's say you want to refinance to 1 million, assuming if the property value does increase. So in this case, you will just need to top up the necessary. So for example, if you choose to upgrade to a new house and right now you took up a loan of 1.5 million, so instead of buying a new MRTA like the previous slide over here you just need to top up another 1 million. So assuming if let's say you have bought this MLTA at age 25 when you first bought your first property, so maybe at 5 years time or at 30 years old you plan to upgrade and buy a bigger house. So in this case, you just need to top up based on the age of 30 years old instead of 25, right? So cash value wise, MLTA, it may or may not have cash value depending on how much are you planning to spend for the MLTA, right? So of course, some people will say that, oh, okay, why not I take a shorter term of MRTA? So in this scenario, assuming if you took a 5 years MRTA itself instead of the full tenure, you can actually see that because it's on a reducing term, and of course by taking a shorter MRTA tenure with the bank, you will pay a very cheap premium. But this is what will happen: your coverage will drop very drastically. Assuming, let's say, your loan outstanding is still around, say, 480,000 from 500k on the second year, but look at here, maybe your coverage will have dropped until 300,000, for example. So this is the danger of if you choose to get an MRTA with the bank, but you're not choosing a full tenure. This is what will happen, right? So which is better, MRTA, MLTA? Of course, if you do have plans for long term to purchase properties where you are taking up loans, having the MLTA over the long term will be much more better, as you don't have to keep rebuying the MRTAs with the bank and also to incur interest over time. But of course, there's no right or wrong, depending on your personal financial situation. How much are you willing to actually spend on the insurance to cover for debts, all right? Of course, if let's say the debts are short term and you don't plan to take any more loans in the near future, say in the next 3 to 5 years time, then MRTA will be actually more than enough to cover, all right? So in terms of the premium wise, definitely MLTA will be much more expensive because you are actually having a much more better coverage. So which one is better over time? It depends on your personal finances. So normally for myself, I will actually advise accordingly based on after assessing your personal finances. All right. So if you have any questions, of course, you can feel free to drop a message down in the text chat box, or you can always drop me a message directly, and I will try my best to assist you on this. Thank you very much, and I'll see you in the next video.